Cool. Oh yeah, there I am. I'm on the microphone. Good morning to everyone. And I think I'm just going to start off. I'll introduce myself. So my name is Ben Weiss. I am a reporter at DL News, this newer crypto outlet from the founders of DefiLlama. I'll kind of just let my co-panelists introduce themselves, and maybe I'll start with Charles.
Sure. So good morning, everyone. My name is Charles. I'm the CEO of the DYDX Foundation. DYDX is one of the leading DeFi protocol. We focus on crypto derivatives.
Hello, I am David DeFi from LFJ, standing for Let's Fucking Joe. We are the market leader on Avalanche as a decentralized exchange, also available on Arbitrum.
And I'm Simon. I'm the founder and CEO of Rare Labs, the creators of Rare Network, which is, it's not an app chain, it's not a generalizable chain, it is a chain that is specifically optimized for trading.
Cool. Well, I think, as I'm a journalist, I like definitions. And when it comes to multi-chain, cross-chain, there's all these different terms fly around. So I thought I'd just start off and say, what does multi-chain mean? What does cross-chain mean? And why, especially for me as, someone who's just writing about crypto, not necessarily super degen, why should I care about the difference? And maybe I'll start with Davide.
So multi-chain versus cross-chain, I think it's a topic that is very interesting. We do not believe that, for example, being a DEX on every chain is a path towards success. We are very committed to the chains where we deploy. So we consider ourselves definitely not an omni-chain protocol, but a protocol that decides where to be. So we are a multi-chain, where in our case is 2 chains specifically, and this requires a very different approach. The majority of omni-chain protocols might be on so many chains that it makes your protocol become diluted across the attention of the users. We have a saying that being everywhere means being nowhere, and our commitment to a chain with a multi-chain approach means that wherever we want to be, we are going to get to the community recognizes us, we are towards a path to relevance on the chain, and if that's not achievable, we'd rather not do it.
Yeah, I think for Charles, for DYDX, you guys just have your own proprietary app chain. So curious, talking about going off of what Davide was saying, it's if you're everywhere, you're nowhere. You guys have said we're one place and that's it. And talk me a little bit through that decision making and why you think that's a good strategy.
Absolutely. So the history of DYDX started in 2018, launched on the Ethereum mainnet. Then it was a protocol which was one of the very early users of layer 2. So DYDX has one part of its history on Ethereum, partly on Starkware. But eventually, I think the engineering team behind DYDX find out that building your application on a general purpose blockchain comes with a lot of trade-off. You get some more time and resources to focus on your application, but the underlying chains give you some kind of framework, and you cannot always go outside of it. So at some point in time, DYDX reached a sizable kind of volumes and activity on the Ethereum side of the history of DYDX. The DYDX recorded $1 trillion of trading volume. So it meant that essentially the engineering team could be building his own chain. There was enough activity. So back in December last year, the DYDX chain Genesis happened. So essentially the chain of DYDX came to life. And what it means for engineers is essentially you start to control the full stack. So you can really optimize the underlying chain for the use case of DYDX, which is trading perpetuals. And we have in the crypto derivative space a little bit of an advantage versus some other use case in DeFi. We don't need to be everywhere. We need essentially connectivity to multiple chains via Price Oracle. But when you trade crypto derivative, for example, if you want to trade contract which is going long Bitcoin on DYDX, you will not need Bitcoin. You will just use a collateral, which will be USDC. So it's easier for us to essentially build our own chain, decide that all the liquidity will be in one place, but at the same time thinking that there is a lot of connectivity to other chains, which needs to happen. And this connectivity does not mean you're multi-chain necessarily, but you are very well connected to other universe, and therefore allow people to connect and to trade different assets. To illustrate that, about 3 months ago, DYDX connected to Solana via some price oracle system built by Skip protocol. And essentially, it enables the DYDX chain to get open to the Solana ecosystem with more than 800 new listable trading pairs, for example. And in a few weeks, DYDX will be connected to all the Uniswap trading universe on Base. So multi-chain approach means not necessarily for us at least bridging or being multi-chain, but more thinking how you can be cross-chain and how you can reverse engineer all the capabilities of engineering and thinking what is the user experience and what does the market want. Market wants to have high liquidity and convenience of one place, giving you potential exposure to multiple users.
And I guess we're into chains and talking about going between different chains, and you were kind of alluding to this when you were giving your intro. So would love kind of your take on this, like being nowhere if you're everywhere kind of idea.
Well, I think it's, so if I can go back to our central thesis, we basically don't believe generalizable networks will facilitate the next wave of DeFi scaling, because by nature of trying to be generalizable, you create a whole load of limitations for DeFi use cases, which is effectively a version of what you're doing at DYDX. The big difference for us is that we have created a chain that can support multiple different DEXes. And as a result of saying we don't want to be generalizable, we just want to focus on this specific use case of trading, what's actually kind of interesting is when you constrain the design space, you actually simultaneously open up a whole load of different avenues in which you can take the chain. And one of the big ones that we've kind of embedded into the network design is we've enabled people to stake into the network. And when they stake, that provides economic security of the network, but also simultaneously creates liquidity that the DEXs on top of the network can consume. And what's interesting with this as a design decision is because the liquidity exists at the network level, when you have multiple DEXs that go live, unlike a generalizable chain, it doesn't fragment the liquidity. So you end up with much deeper markets and better trading conditions for all of the traders that operate on those exchanges.
Gotcha. I mean, you were saying when we're looking at the next wave of DeFi, right? And DeFi TVL, in 2021, we were at 180 billion in terms of total value locked across all chains. And we're now at half that, approximately around 90 billion. But that's kind of interesting given that there's been a lot of new innovation, a lot of new chains, a lot of new protocols that have happened, but there still hasn't gotten that wave of retail user interest and using all of these different new technologies. And I guess it's always the big question in DeFi, what will actually, and crypto more generally, what will onboard the next billion users, what will make people want to use these new products. And I guess I'll open up to you guys, why haven't we seen the same explosion given all of the new kind of things in the market right now? And what do you think will, get us there? I don't know. Davide, you're looking at me.
Yeah, so the conditions in the market for liquidity have changed over the years, and we have seen a huge shift into how the average users prefers to handle their liquidity. It all started when we were doing the good old TVL things on every farms, where basically every protocol was rewarding liquidity for simple 50-50 style liquidity, but that was also very inefficient. And then we evolved towards concentrated liquidity protocols, which have supported way more volume with less liquidity necessary in the market. That's why we moved away from the 50-50 model towards creating liquidity book or concentrated liquidity protocol. In this case, with the liquidity that was leaving the market during the bear market, we managed to sustain continuous and higher volume without having to rely necessarily on having to look for too much liquidity on less efficient models. And now I know that we are going towards even higher efficiency, level of trading where we see a lot of next wave of what could be what could be the next generations of scalability solutions. And the volume is going to be the volume is going to follow definitely the trends of the market, but with very high volatility, liquidity tends to leave the market because they try to avoid impermanent loss. And with high volatility, the impermanent loss skyrockets, of course. And given that concentrated liquidity exposes this liquidity to a way different degree of manual management of your liquidity, this is also a reason why today the TVL has taken a step back and is waiting for a less volatile time.
Gotcha. That's interesting. But maybe Charles, can you like, I'm dumb.
You're not.
Yeah. So can you
You're not.
translate that?
You just need one more
what does that
coffee.
mean?
That's all. We all need a coffee in the morning. The way I look at this, I think the internet is evolving, and Web3 is one illustration of the evolution of the internet. And there is this narrative of the internet evolving into the split internet. I spend a lot of time in Asia, and what we start to see very clearly is that there is different parts of the world, and sometimes billions of users of the internet, which are not consuming the internet the same way. So if you look at Chinese, they don't connect to the internet via Chrome anymore. They use WeChat, these super apps. Same for the Korean with Kakao, the Japanese with Line. The elephant in the room is the Telegram ecosystem, which is growing as well. So essentially, I foresee that there will be some kind of walled gardens, which will be very powerful walled gardens. And this might be impacting, to come back to your questions on why the TVL and the activity is not maybe starting immediately after the beginning of the bull market. We have the cycles, but we have also a totally new distribution kind of framework coming up for DeFi in general. So I think a lot of Web3 products are still doing business development in DeFi, thinking they need to bring users to them. And we know from experience it takes a lot of time and resources, when actually the internet around us and crypto around us is evolving tremendously. We see the level of activity on wallets versus centralized exchanges evolving very quickly, and the wallets are becoming this kind of walled gardens. We see these super apps which are bringing more and more traffic and keeping the audience and the eyeballs within their apps. So I think it's important for all of us in the industry to be kind of aware of this evolution of the landscape and rethink our distribution strategies in order to bring the products where the people are, rather than trying to bring people only to our own front ends.
I guess, like, has that happened though? Has DeFi brought the products to where people are going? And maybe Simon, if you want.
Well, I don't think we have yet. I just maybe to go back to the numbers that you were saying at the beginning, what, 180 billion to 90 billion?
Yeah.
I mean, that's from peak hysteria to now, and we've had three pretty significant events since then. You've obviously had Terra Luna, which was 50 billion on its own. FTX, obviously everybody knows about, and then we've had huge change in the rates environment. So
It's huge change in what?
in the rates environment, which just I think naturally just takes capital away from risk on assets. So that's obviously all changing, and for everybody that's been in the industry and kind of been building through that cycle, what I think we've seen is we've just seen that the capabilities that exist on chain have just changed dramatically since that kind of 2021 period, where what we can actually build on chain now, I think in many respects is not just at feature parity, but is actually starting to surpass what you can build off chain. And distribution models obviously need to kind of evolve. We probably do need to do some more stuff where we actually go to where the users are. But what's extremely bullish from my perspective is that the underlying infrastructure is, at this point in time, it is actually getting to the point where it is better than what exists off chain.
But do you think that, like, DeFi missed its chance, right? Like, it was this peak hysteria, and back then the technology wasn't nearly as good as it is now, and now the technology has gotten so much better. And now, but retail consumers are obviously a little bit more wary, given the events that you've been talking about. Also, kind of DeFi is known notoriously because of its decentralized nature for scams, hacks, rug pulls, etc. Like, how now that technology is better, how do you and how do you get users interested in again? I mean, part of it is the distribution thing, but isn't it also a reputational question? And maybe, I don't know, who wants to, and Charles is looking at me.
I guess I guess what you where you want to bring us is to the trust element in crypto and DeFi. And like, why will people keep using a credit card versus maybe some stablecoin or DeFi protocols? Eventually, we are all building on trustless technology, but we are still in the business of trust, and finance is a trust business. So I believe the big brands in CeFi, the big brands in TradFi, will be magnets for the new waves and herds of users. And it's very important to keep building our brands, to keep building like trustless technology, but keeping in mind that the users needs to anchor their trust everywhere. So when there is scams around and when there is all kind of things happening in crypto, there is also very big players coming in. The first player coming to mind is the central banks. I think 100% of the central banks nowadays are working on CBDCs. Nothing to do with DeFi exactly, but it's a kind of a testament that the technology is working and there is a use case, and this will only accelerate. If you look at the trajectory of USDT or the trajectory of USDC, you see also that the payment, which is a base of any financial flow, is evolving towards DeFi also and stablecoin. So we need to give it some time, but the signals from BlackRock tokenizing treasuries and money market funds and many other use cases are showing us that this is definitely coming our way.
But you were saying that like almost, CeFi or these like central institutions can act as almost the trusted gateways into, like DeFi and finance. Is that correct? Is that kind of a good approximation?
It's trustable for many people. I think people don't check.
Then
Right?
I guess my question is that like maybe for Davide, right? Like you're, LSJ, like it's much more DJ. Like, do you want like it should CeFi be the gateway, the trusted gateway? Do we want to have that be, the way that people enter DeFi? I don't know.
Yeah, embarking users in DeFi, I think personally is the dream since I've discovered the blockchain, and educating users to self-custody is the safest thing that we can do, I believe, in this industry. And what truly matters in this path towards user safety, as you were mentioning, is having an approach that you feel is the right for your product. Our developers have done a tremendous job in keep developing every new product that we implement to the market is single-handedly written by our developers. We reduce third-party dependencies by, instead of integrating third-party solutions, we create the solutions in-house, audit them completely, having immutable contracts. This for us is safety, making sure that the contracts are the safest possible, having everything trackable and open source so that everything, any interaction that happens on the blockchain can be easily visualized in the wallet, and the users is aware of every step they are taking. For us, this is extremely important because it brings education back to the user. And once a user is educated in what it means to make a swap by looking at the transaction, the input and output that they're going to see, they start to understand what are good acting operations that they are doing on any platforms. And the more we achieve this level of transparency, the more users are going to be well educated in recognizing what's safe for them versus what could be not understandable.
So I guess, I mean, like, but who's doing the education? And maybe that's where I'm getting back into the centralization versus decentralization thing. And Simon, you look like you kind of want to jump in based on like, this prior cover.
Well, I think education is part of it. Just if you kind of really zoom out, the innovation is clearly taking place on chain. And when you're talking about like who's going to come in and start interacting with those products that exist in that ecosystem, there's retail is obviously one part of that. Institutional is the other big part. And if we think about and look at what the likes of BlackRock are doing at the moment, I think it is quite clear that there is an inflection point really that is about to start happening, where a lot of these institutions understand that they can distribute to the on-chain economy. And actually, that's where kind of the innovation is taking place. And yes, education needs to improve, but it becomes a really interesting distribution channel for those large institutions themselves.
But do you think then, like, so I guess then the question is like, what's the point of these protocols, right? If they're catering towards more retail users, right? Because like, DEXes, Swap, all of like, different protocols and projects you guys do, like, presumably a good amount of the volume is coming from smaller people.
Yeah, what's kind of interesting, if I just talk about it from a rare perspective, over 90% of the volume comes from institutions on Rare Network. You kind of would assume that it'd be kind of very retail heavy, but it's not. There's the actual infrastructure that's being created is extremely low latency, extremely high throughput, extremely deep liquidity. So it creates a kind of a very reliable and dependable trading environment for institutional traders. And we've seen them come in their droves, and they all integrate directly on chain. They trade directly on chain, and that's what's driving a lot of the traction at the moment.
Is there a tension, I guess, kind of when we're talking about this, is there a tension between catering towards institutional investors and traders and catering towards retail? Because obviously their level of knowledge, their level of capabilities are different. I don't know whether you guys, as protocol developers and custodians of the DeFi system, I would say, have thought about this.
I think we find the same patterns as the equity markets. If you look at how the equity market volumes kind of split between institutional trading and retail trading, retail is a big part of it, but most of the volumes and activities coming from institutional. So it's not abnormal to see DeFi starting with institutional. And I think this is where the CeFi and DeFi will eventually meet, where CeFi has been doing a great work at bringing retail users. If you look at the number of millions of users on Coinbase, Binance, OKX, and so on, these places of CeFi have been able to onboard these retail users, and I foresee that the users which don't change so much, they just want convenience. They will eventually use CeFi as a core on ramp and off ramp, fiat to crypto, and maybe for spot trading. But eventually, all these centralized exchanges are in a global race to acquire licenses, and those licenses they acquire in different countries are for the most part only for spots. So we start to see signals from the CeFi industry that they will eventually building some gateways to DeFi and trying to keep users within their ecosystem, having like as a gateway to their ecosystem, their centralized exchange, but their Web3 wallet helping them to access DeFi. Should it be for lending, crypto derivatives? And I think the distribution will change this way, where users will want to trust a big brand they know, which is regulated. And this big brand will be an aggregator, a little bit like the way financial products are distributed today. I don't see why this will be reinvented. It's just what the market wants. I'm banking with my bank, and my bank core business is a saving account, but they also give me access to stock market via a broker. They give me access to insurance via an insurance company. So in TradFi, financial products are essentially distributed by aggregators, which are the banks. I don't see why in DeFi we will not get this kind of aggregators. Maybe some users will consume aggregations via a non-custodial wallet, but I think many people will just choose convenience and go and consume CeFi and DeFi via centralized entities such as Coinbase, Binance, and so on.
I mean, maybe we're repeating ourselves, but I guess like one different way of taking that, Davide, is like, when was LFJ founded, like created, like as a protocol?
2021.
And I'm assuming then, right, you weren't catering towards institutional investors, right? You were catering more towards kind of like people that were online and just like wanting to, I don't know, do swaps, do different types of stuff like via your protocol. Like, are you starting to think about catering towards more institutional investors now? And like how to, and how is that becoming your new client base?
I mean, actually, this is very interesting. Beyond the initial wave of users in the 21 sector, especially in between 2022 and 23, we have had, also thanks to our partner blockchains, which are doing behind the scene tremendous job in trying to embark all institutions towards their different solutions, which could be dedicated layer 1, layer 3s of sorts, dedicated to their space. We have every month we have conversations which are mostly and they've been on the education side on institutions wanting to participate in liquidity pools. As of now, it seems to be that the next trend of, let's call it decentralized finance for institutions, is going to take place on permission liquidity pools or or permission blockchains, which will have the users, the institutional participants participate with each other on pools that have gone through some type of KYB, but they are still trying to find a place where the middle agent will be the one that they interact with, and then they will be able to access more decentralized pools. It's mostly a topic, I think, today about regulations and what they think it's the correct way to approach decentralized markets, but the attention has been there since years, and they are very curious about the different type of primitives as protocols that are available for this type of use cases. What's missing is actually the liquidity on these solutions. We are very much at I think at a technical understanding on how to execute it correctly, and then we will see a certain point where the faucet is open and they are all going to participate in these markets together.
Do you think then, I mean, maybe Simon, like, and I guess this is the theme we're circling around, right? Isn't there a certain irony, right, that institutions, you were talking about permission blockchains, Davide, and we're talking about institutional players being kind of the next key towards whatever the next wave in DeFi is. Is there an irony there, given that like DeFi is supposed to be kind of this place where there are no institutions, there are no, they're kind of like the sovereign, quote unquote, individual that's just, doing self-custody?
Well, I think we're just talking about different user groups fundamentally, and there's a big user group which is retail. There's a big user group which is institutional, but in institutional, you can break that down into like probably about 10 different broad buckets. And when I say that the fastest kind of growing user group that we observe on Rare Network is institutions, there's like a crypto native institution that's obviously very, very different to the likes of BlackRock and another regulated institution. And their needs are obviously different, and they would need some sort of permissionless chain. There's an analogy which someone has said to me in the past around, if you think about water kind of flowing down a river, there's always a point in the river where there's the fastest moving water. And what typically happens is across those different user groups, there's just a point in time where one of them is the fastest moving bit of the water, and that's what everybody then like piles into catering to. Personally, I don't think that's going to be the kind of heavily regulated institutions that need permission blockchains, just because they typically move slower.
Gotcha. I mean, and kind of, we've got like 2.5 minutes left, 2 minutes, like, on the topic of regulation, I'll maybe just expand it out, right? Obviously, it's a fraught issue. Do you think it will be ultimately helpful, right, for DeFi if once there's regulation to come into play, that will then eventually encourage these institutional players? And maybe Charles is nodding. So, yeah.
Maybe two things come to mind. As an industry, our responsibility is to stay engaged with regulators. That's number one. When engaging with regulators, we should not be claiming DeFi is better. We should be demonstrating DeFi is aligned with the agenda of regulators. And regulators have very clear mandate. And if you look into the details, there is plenty of elements of the mission of regulators which are systematically kind of executed by DeFi. So that's the first thing. Don't claim, but demonstrate. The second part is, I think eventually DeFi will evolve and we will see projects kind of becoming dominant. But I see more regulations coming towards operators rather than the protocols themselves. A little bit like the early days of the internet. Back in the late 90s, governments were saying, we're going to speak and we're going to find the CEO of the internet and we're going to regulate the internet. But you cannot regulate technology. What you can regulate is the operators of these technologies. That's why the internet access providers in the US, Europe, and elsewhere are regulated by their own government to make sure they apply like local rules. And I think we're going to eventually converge towards this kind of regulation framework where operators on the top of DeFi, global DeFi and global liquidity will be regulated and provide access to global DeFi networks under certain local rules, to really be American rules, European rules, or Asian rules.
Got 30 seconds left, but maybe I don't know. What do you guys? Let's a quick 15-second question. Simon smiling. What are you most excited about in DeFi and a sentence?
I think we're at the inflection point where what we're building on chain is not just at feature parity, but better than what you can build off chain. And honestly, I think as everybody starts to realize that, it's gonna take off.
Cool. Okay. Well, that's it for us. Thank you guys for hearing us out, and stay tuned for more cool panels afterwards.
Thank you.
Thank you.
Cool.